First, I'll say that I'm wrong. Anybody who thinks they can predict oil prices is wrong, and so I'm not even going to try. We're taking it from a little bit different perspective. And as mentioned earlier, if you have a flask in your coat, this is the time to use it. We have gone through down cycles before, okay? Everybody in the room with a little gray hair has been through several. I think I've been through 5 or 6. All of them, I got into the business in the late 70s, so I got to see some of the ugly ones. This is expected to be the second worst down cycle in the last 40 years. Okay, I agree with Matt. This isn't the 80s. This is a completely different world, but that doesn't make it any better, really. And when you think about it, the oilfield services industry as a whole generated all-time record revenues and income in the fourth quarter, the quarter that just ended 3 months ago. All-time record global revenue and income, and we are now dropping into the second worst down cycle in 40 years. So the idea that we have, in 3 months' time completely discounted everything bad that's going to happen and it's time to buy the stocks seems a little incongruous to me, but we'll see. Everybody knows oil price has been cut in half. One point here, nobody's immune in this. Somebody asked me earlier, where's a place, a safe haven? I don't know, biotech, industrials. It's definitely not in energy. But what's different this time is this is a supply-induced down cycle. Okay, you've all read in the paper where demand snaps back or bounces back. And in 2009, quantitative easing by the US allowed demand to snap right back. And Matt mentioned the recovery in 2009. When the stocks and oil prices bottomed on March 9th of 2009, by July 1st, the oilfield services index was up 62%, okay? And so everybody's looking at that saying, I want a piece of that this time, okay? But this is a different cycle. That was a global economic interruption. This is supply, and that's different. Trying to get E&P companies to not grow production is tough. You see I've got the vampire with the toothpick analogy. Last week I was in Chicago, and we made the point that it's like taking an Irishman's beer away on St. Patrick's Day. I was actually in Chicago, got to see the Green River. It was a lot of fun. But it's very hard to do. And so my background is in engineering and geophysics. And so the way we look at this is you have to not only drop the horizontal rig count, that's all the rigs drilling for shale, which is all we really care about right now. You have to drop that rig count by 30 to 35%, key point here, and keep it there for 4 to 6 quarters to get US production growth close to zero. Now, when you talk about high grading prospects, oil companies no longer having to drill to hold acreage, 20% plus cost inflation expected, and already realized to a large extent by the E&P companies, that stretches that time frame out even further. EOG, we put out a piece titled Leadership. EOG came out and said, we recognize the problem, and the goal is to get US production growth to zero, and as a company, we are going to get our production growth to zero by the end of the year. Several firms, such as mine, though we didn't, downgraded the stock. The stock was down 8% that day. Nobody wants to be the hero and do this. No one operates in the industry's best interest. No one operates in individuals, consumers' best interest. No company operates in anything but its own self-best interest. And so what you will hear companies say is, I understand that the goal is to get production growth to zero, but we're still going to grow our production by 22%. And it's all those other people who have to slow down their production growth, and as soon as I find out who those other people are, I'll talk to them and give you a report. But it just doesn't happen. And so this is an issue. You need our production growth. The world needs our production growth. We have been 80% of all the production growth in the world for the last 3 years. The problem is that we've been too good for our own efforts. Last year we grew production by, I might be getting ahead of myself on slides, we grew production growth by 1.7 million barrels a day. And the world didn't need that much production growth from the US. That's the problem. This is one reason why Saudi's not likely to cut their production to accommodate us. They're not going to operate in our best interest and in detriment to their own. And since we're the one that caused the problems, while we would love for somebody else to come bail us out, we actually have to do it. And so The problem is that the next time, if you look at general supply-demand models, the next time you need the U.S. to grow production at 1.6, 1.7 million barrels a day is in 4 or 5 years, okay? That means that the fourth quarter horizontal rig count of last year, which was the proxy, if you would, the average proxy of horizontal drilling for the year, which grew that production by 1.6, 1.7 million barrels, isn't likely to be seen again for 4 years or so, okay? So we're not gonna get back, according to that analysis, to last quarter's level of activity for 4 years. So Jeff Miller, the CEO at Halliburton at our conference a couple weeks ago, said that this isn't gonna be a V-shaped recovery or a U-shaped recovery. This is going to be a bathtub-shaped recovery. And so you can see that here, and I think that's probably the most appropriate, and since I think it's a really clever thing, we're stealing it every chance we get. Now, it's not all bad, because we will become an industrial-like oil business again by 16. Once we get production growth to zero, or close, we will start growing production from that point forward. The problem is, we will start growing on a secular basis of about 3 to 5% annual growth, as opposed to the 8 to 10% annual growth we saw from 2010 to 2014. But it will be a good industrial-looking business. We don't have to find oil anymore. We know where it is. But it's an interesting point, and it's not on this slide. For all of our careers, the oil price has gone up to try and stimulate production so supply and demand are met. Okay, for the first time ever, now oil prices actually have to stay down as a governor on U.S. production growth. Now, a number of people are saying that oil prices will end this year at $75. If you account for 20 to 25% cost deflation in the industry, 75 is the new 90 or 95, right? And at $90 to $95 oil last year, we grew production by 1.6 million barrels a day. So the idea that we will exit this year at a commodity price that will allow the industry to grow production at that rate again in 2016 is, in our opinion, not likely. So we think it is much more likely that you are in a $60 oil world for the next 2 years, and that oil acts as a governor on that activity. So that was the depressing part about it. It's not the end of the world, it just feels like it. Here you see we've increased oil production. We're very good, and that's the problem. Everybody complains about the XL pipeline, which is correct, and we can't drill on government property, and we have hydraulic fracturing rules coming out. If you ask anybody in the oil business, operating in the U.S. is 10 times better and easier than operating in any other country in the world, okay? We have individuals who own mineral rights and individuals who profit from either drilling or gathering systems or midstream. This is the only country in the world where individuals own mineral rights. And the people who own those mineral rights or right-of-ways benefit economically. And so everybody wants to play. So when the U.S. revs up, we rev up faster than any place else in the world. We are not the lowest cost provider, but we can increase our volumes faster than any place else in the world. And that's a key here. So trying to get the E&P industry to grow isn't tough. Just give them enough money and they'll go crazy. The only way to get them to slow down is to take money out of their pockets. Now, so far this year, we've raised $9.2 billion in equity offerings for E&P companies. So Wall Street has given them $9 billion to supplant their cash flow shortfalls. And that means that you're going to have the oil prices come down equivalent to wipe out another $9.2 billion in cash flow to accomplish what oil was set out to do. So this is our concern in the market. Now, again, longer term, we still see a good market, but it's going to take a while to adjust. You've seen this. This is the most severe drop in the rig count in history. These are all the previous down cycles. The issue isn't whether this looks like '09 from the front end, it's what the recovery looks like. Everybody's saying, well, the rig count's going to bottom sometime in the next 2 months. It's going to get dark tonight, too. I don't know if y'all know that. That's pretty damn obvious. What happens after that is the critical point, and so that's what we think everybody should focus on. So we think that the rig count will drop 1,000 rigs. It'll stay flat for at least 4 quarters. U.S. production growth, we're not trying to get production to drop like the government. We're just trying to get production growth to slow down. Okay, so we're not talking about U.S. production going down, we're talking growth going to zero. I think I've covered most of the stuff on this. Technology and the structural business improvements will dominate. And this is kind of a key point. The collateral damage to the international markets is going to be significant because international in the entire Eastern Hemisphere, we have not grown production at all in the last 3 years, even though capital spending is up 8% compounded for the last 3 years. And so now you're starting to see the North Sea slow down, West Africa slow down, and if you would, collateral damage from a lower oil price. But the problem is oil prices going back to $90 to $100 that would make those projects now economic or better economic still causes the U.S. to overproduce. So the entire world and the entire oil services business, and mainly the major oil business, all have to go through a step change in how they operate, a step change in process and procedure, and structural changes to the industry rather than just the cyclical changes that we see happen. We accomplish all these things, we'll return to a return basis. It's interesting. Last year, Exxon, Chevron, BP, and Shell all announced they were abandoning production growth as a target. Everybody laughs saying, well, you hadn't grown production for 5 years, so what are you giving up? But it was their strategic focus for the last 5 years. And they all announced they instead were going to focus on growing returns rather than production. Exxon in the third quarter of last year had the highest earnings they've ever had with the lowest production since 2009. In my universe, Schlumberger, Halliburton, Baker Hughes have all shifted from a growth mentality and compensation structure to one of returns. And so people haven't particularly noticed this, but the oil industry changing from a growth industry to a return industry is exceptionally positive and will drive the structural changes we're talking about. Deepwater, I'll mention this briefly. Deepwater was rolling into a down cycle even before the oil price crashed last year. We gave a speech in October for the Petroleum Equipment Suppliers Association, and we said that we'll start stacking rigs in the next year. Everybody died laughing. After we gave our presentation, one gentleman stood up and said, no offense, you're dead wrong. He was the CEO of an offshore service company. He said, we need 200 more rigs just to meet demand. And I told him that my wife walks through Harry Winston and sees all sorts of stuff that she wants, but since I'm broke, we walk out empty-handed. So availability isn't the point. Returns are. And so the IOCs had been pressured to return more cash to shareholders, and cost inflation in Deepwater had gone up so much that the Exxon, Chevrons, BPs of the world started shifting a little bit of capital away from the 7-year cash cycle return of Deepwater, where returns are 11 to 14%, more to onshore U.S., to Matt's point, onshore U.S., where returns, cash cycle returns are 3 years, and you've still got Eagle Ford returns on individual wells at 40 to 50%. And so we see this as a longer-term secular shift. It's a business cycle. It'll take Deepwater about 3 years to adjust their costs. And again, step changes are needed, not only in the technology, but in the behavior of oil companies. Now, that usually doesn't happen quickly, but it's often speeded up by low commodity prices. When we gave that speech and we got laughed at several months ago, we have now stacked 24 rigs, offshore rigs in the market, and Transocean announced last week they were going to stack 13 more. So by the end of next month, we will have almost 40 deepwater rigs stacked in a year and a half. FIDs are final investment decisions. Everybody's waiting for prices to go down, and so before they lock things in, and so all the deepwater projects are being pushed to the right. Now, some people say, well, that doesn't matter. They'll eventually get done. If you're a manufacturing company and you have a bubble go through your order book, then it is exceptionally punitive to companies in the industry. And so this is a business cycle, and it'll get fixed, but you've seen a 10 to 12% compounded growth rate in deepwater spending for the last 6 years, and that's what drove inflation. And going forward, we think that's going to be closer to 3%. But all of this will happen and things will be right with the world. In an example of a cyclical business, the deepwater rig order cycle is what you see here. And you can see that we can go from ordering 35 rigs delivered in 15 to having basically no orders. We don't think there'll be any deepwater rigs ordered for the next 2 years at least. We had several generalists at our conference who looked at this and said, well, you say 2 years, that's great. We've listened to this. Why couldn't it be 6? And the answer is because we don't want it to. And we're hoping that works. Collateral damage, 74,000 jobs have already been cut by my companies. CBRE, the real estate company, says there's going to be 100 to 140,000 jobs lost in Texas alone. We're having the conversation last night. Anybody who thinks they don't work directly or indirectly for the oil business will find out that's different. 58% of office space in the city of Houston is by companies directly or indirectly in the oil and gas business. And so it'll hurt. E&I and Insco have already cut their dividends. More likely, you can see where it's slowing down. There is no question. My company's letters went out to every company in my universe. Cut your prices by 20 to 30% or you won't work for us anymore. And it was a daisy chain. They sent then their suppliers letters. And so the pressure on the industry is significant. And as an example, one of the larger oil field service companies will likely see its margins from the fourth quarter, which were almost 20%, come in the first quarter in single digits. That's a 35% sequential drop in revenues at 60% decremental margins. That from a financial side tells you how quickly this has gotten, how bad it is. When does it break? We think soon. My companies are going to start reporting earnings next month, and that's going to be about the same time that Cushing gets full. We had Williams companies and BP speak at our conference. Williams controls 30% of the storage at Cushing, and both companies said that when Cushing gets full, oil will go to 30. Now, I said at the very beginning, I'm not foolish or smart enough to tell you where oil prices will go. At the time, oil was 52, so I thought to myself, lower works. So I have no idea how low oil prices will go, but oil prices are likely to bottom sometime in the next 2 months. And when oil prices bottom, oil field service and E&P stocks bottom as well. So now we are back to, you should buy them when they bottom, but you should have realistic expectations of the recovery. So the duration needs to be better understood. It's been interesting. We've had 3 big credit offerings, Energy 21, Goodrich, and Comstock. And Comstock was the last deal. The debt traded down 26 points the day after they priced it. And then day before yesterday, Whiting, who had been rumored to be for sale or selling properties, which caused all the hedge funds in America to go long Whiting stock, then did a $1 billion equity offering that priced down 22% from the last trade. So the credit and equity offerings you've seen in the oil business over the last several months may very well be coming to an end. And all that combined is likely to cause some bit of a crisis. I had mentioned we'd gone to Boston 2 months ago. We had 25 people show up at a breakfast and figured they had $100 bills coming out of their pockets. Which stocks do we buy? We're going to get rich. And I thought to myself, this isn't what a commodity industry bottom looks like. A commodity industry bottom is when 4 people show up. None of them want to be there, but their bosses made them. And 21 guys call up and thank God you kept me out of these stocks, Wicklund. I'll call you in 2 years. That's a bottom. The hardest time to buy a stock is the best time to buy a stock, not when everybody is lined up with their pockets full of money dying to get rich. We don't think they're there yet. Since mine was mostly verbiage, I decided to throw in a couple of slides. This just shows oil storage. In my world, everybody says, yeah, that's already known. It was on page 7 of the Dallas Morning News a couple of weeks ago. That in my world means most everybody probably knows it. It doesn't stop it from happening. We are at the highest storage levels. That's the chart I like. Okay. The blue line is the weekly storage. You can see we're at the highest level of storage ever. The other side of the coin is we now have 5 pipelines that can take that crude from Cushing down to the Gulf Coast where we have storage. So that just means we'll blow out Brent and WTI, and then we'll start blowing out Brent and LSS later, and it'll see how low that oil price goes. So we haven't reached bottom yet. We're close. The goal is to stop production growth. Nobody makes easy money at the bottom of a market. The collateral damage is one thing I would pay most attention to in the international markets. It's not the goal of what's going on. And people think Saudi is trying to do this to be punitive to Iran and Russia. Those are side benefits. What they are doing is taking the path of least resistance. We're doing nothing. We're changing nothing. We're going to keep producing. We're going to sell our oil to our customers. And we're not going to cede market share to the interlopers in the U.S. One analysis showed that OPEC would be better off if they were to have cut production, their quotas, from 30 million barrels to 28.4. But if you look at the analysis, they would have to cut their production to 28.4 this year, 27.4 next year, 26.4 the year after that. That would be the impact to OPEC of supporting oil prices at the levels we saw last year. And the likelihood that OPEC gives up a continuing decrease in market share, in our opinion, is unlikely. So we have to fix it. We will fix it over the next over the next 6 or so quarters. We're close to a bottom. We think it'll be uglier than some of the more optimistic people look. Having been through these cycles, everybody will get rich again. Thank you very much.